Hi, good evening all, and thank you so much for joining today's exclusive webinar on ELSS. My name is Ashish Asthana, and along with us, we have a great personality from the industry, Miss Usha Nair, who's a Senior Vice President and Head with DSP Mutual Fund. Ma'am, we welcome you to our show.
Thank you. Thank you, Ash.
So today we are having investors have joined in large. I really welcome all of them for this live session. It will be an interactive session. We would be definitely taking Q&A. In case if you have any questions, you can post. We will be taking it before we end the session. And so primarily, ma'am, ELSS still, I believe, to few of our new investors who have recently started or who have opened the account, they still find it as a jargon, right? Why ELSS? It is a tax saving season, right? This is the last quarter, and being the last month of the year, still we have time in case usually people are busy in their work. We give least priority sometimes, or we tend to forget about it. So how this product within the category of ATC can be beneficial, what tax benefit they get, how ELSS is a one of the best product under the category, we would like to know from you. And also if you can throw some light on the current market overview, how the markets are going to be, that's all our investors would like to know. So with that note, I'll hand over to you.
Thank you, Ashish, and thank you to all the participants who have joined this program through HDFC Securities. As Ashish mentioned, Equity Linked Savings Scheme, that is what ELSS stands for. As salaried employees, as people who get income through our various businesses, we have this provision to save tax from the income that we earn through various modes that the government and the income tax department allow us to do. It is under section 80C, we can save up to 1.5 lakh of rupees, which will give us investment benefit, because all these products will give you return on the investment that you make, as well as allow you to pay lesser tax as per the income tax slab under which you qualify for. What does equity linked savings scheme do? It is, as the name suggests, it invests in equities in the capital market, and the idea behind it is to encourage investors like you and me to participate in the capital market or the stock market through mutual fund route, which is managed by professional investors and also guided by distributors or advisors like HDFC Securities. It has a 3-year lock-in. All tax saving schemes, be it PPF, be it small saving schemes, be it certain bank deposits, any product that allows you to save tax has a lock-in period. Equity linked saving schemes, or ELSS as they are more popularly known as, has a least amount of lock-in, which is for 3 years. So once you invest the money gets locked in on your invested amount. You do get tax benefits. What is the advantage of ELSS? ELSS is the only scheme among the tax saving category that is linked to stock market behavior. It allows you to participate for a longer time in the capital market with smaller tranches of money that you're investing to save your tax, and gives you much better risk adjusted returns or better returns than your alternate products. We have PPF, which comes at a fixed rate of interest, and the lock-in is for a very long period of time. Even your withdrawal from PPF is at smaller amounts after a certain threshold of number of years or lock-in is over. Then we have certain small saving schemes, certain bank deposits, etc., which allow you to take tax benefits. However, all of those schemes give you a fixed rate of return, while on one end it is advantageous when you know that the money is invested for a longer period of time with a tax benefit. It always pays, or it is encouraging to do it through schemes like ELSS, where your outcome or the return that you can generate is far higher. That is what is time tested, and provided you invest for long term, that is what capital markets does to you. So not only does it give you tax benefit, but it also allows you to enhance your returns over a longer period of time. So in a way, it gives you twin benefits. That's the advantage of investing to save tax through ELSS schemes. There are various schemes available in the market. Many of these schemes have been there in the industry, in the mutual fund industry, for a long number of years, and therefore it is easy for you to understand and look at the performance and the experience clients would have had. Besides that, partners like HDFC Securities do suggest through their portal what are their recommended schemes through which for which they do their research, and post that is how they reach out to clients like you and recommend that these are some of the schemes to save tax that you should be considering. Coming to the second part of the question, which was on the market, the most important thing that has been happening in the market and what is creating a lot of noise is the coronavirus. Something that started a couple of months back, originated from China, from a particular region or province in China, and today it has got spread out. And the calamity, because there is no vaccine or a treatment available, there is and some amount of deaths have also happened. It has been there has been a lot of fear, though it has not been declared as an epidemic by the World Health Organization. There is travel ban. There are people canceling their, holiday plans. A lot of airline and many manufacturing setup in China has already been shut. So there has been, and China also being the largest manufacturer for the world. Most of the goods that we consume, some part or the other of that comes from China, because of which when they have a shutdown, when the manufacturing facility shut down, the export that Chinese do will get impacted, and these have got large impact on the world economy. Having said that, the correction in stock market is always an opportunity to build to your portfolios. So today, because of an event which is completely medical in nature, not to do with the fundamentals of the business, it has given you an opportunity to invest the same set of companies that you would have invested, or the same set of mutual funds that you would have invested 1 month or 2 months back at a higher price. So like as buyers of various products, we get excited about a discount that goes around in the during the discount sale or during the off season sale. We can look at this as an off season sale that is happening in the stock market. Some of the good quality companies which one wishes to buy is available to us today at a discount due to a reason which is currently looking very alarming and scary. But over a period of time, we have seen in the market that many such events happen, and market recovers from those low levels, and the fundamentals will start showing, and that is when the investor would have made a good benefit out of investing.
Absolutely, that's really great, ma'am. And I think as a part of ELSS, we are already having a DSP tax saver fund. So if you can throw some light on that, on DSP tax saver fund, what is the thought process behind it? Because we see the CAGR returns that, and of course as the markets were impacted, but still we see a 5-year CAGR at present is about 8%, and 3 years about 7.3%. And really great to know that the AUM of the scheme at present is about 6,000 plus crores. So which is definitely a good sign. So what thought process you have in this particular scheme? Because this scheme is also a part of our reckoner. And let me remind you all our viewers, I will be also showing from where you can see these details and how you can place your orders from website as well as mobile. So first we would like to know what is the thought process for this particular scheme that
yeah. So as I mentioned to your first question, Ashish, that DSP Tax Saver is our offering which allows investors to invest and claim tax benefits under Section 80C. It is our equity linked savings scheme. The scheme has been in existence for more than 10 years, and we have generated a return of close to 13% since inception. And you did mention the return of last 5 years and 3 years, which is more than 8%, and 3-year return is about 7.3%. It is in line with the market in terms of return outcomes. It has done better than its benchmark. It's a multi-cap oriented product, which will have an 70% exposure to large cap stocks and about 14% to mid cap, and a very small exposure about 8% to small cap stocks. So that is the construct of the portfolio. It's as I mentioned that usually the amount that investors save is a maximum of 1.5 lakhs. Few investors put in a little more of money, so it is a product at 6,000 crores which has got large number of investors whose small amounts of money has made it to reach the level of 6,300 crores. So that gives us a lot of joy and pride that we manage the money of our investors, which has come to us in a small quantum over every year. And for every year to do tax saving, investors add more money to their existing folios. And that is how the corpus of this fund has come. It is not created by a few large investors, and therefore, the return or the fund is skewed towards a few large investors. ELSS scheme with a long-term track record, created and built by investors who are the type of investors who have logged on to our webinar. And we are very proud and happy that we have been able to do justice to our investors, both through the systematic investment route people have invested. But in months like January to March, usually people go for the lump sum, because and this year particularly good because markets are giving us an opportunity to buy stocks at a discount, and that makes the return outcomes for investors far superior than what it is otherwise, because when I'm buying at lower valuations, my upside is always better in a 3-year product. The other advantage of ELSS is, by necessity, it is a 3-year lock-in product. What we experience is, much as we say that, you suggest to investors that all equity investments are meant for long term, when you see market turmoil the way it is currently happening, it is possible that the investor gets nervous and has a temptation to withdraw from the investment that he has made. In an ELSS fund, that temptation by the structure of the product is naturally contained, and 90% of the investors end up benefiting by having a lock-in period. So in months like this, when markets are correcting 6% and 7%, much as I may desire and be scared about my investments, the lock-in ensures that the investor does not succumb to that behavior, and when the markets rise subsequently, he becomes the beneficiary out of it. So that's about DSP Tax Saver Fund.
Thank you so much for such a valuable inputs. So now I will show our investors where they can check the scheme details and how they can apply. For that, I need to share my screen. I will share my computer screen. As you can see in your screen right now, this is our website. That's www.hdfcsec.com. This is our pre-logged in section, wherein out here you can just put in the name of the schemes. This is a get code section. However, you can go to the research section also, or you can go to the product section also to further check the information. But instantly on the get code page, if you type DSP Tax Saver Fund, this is how the page would be displayed. And right here you can see the scheme details. You can see what is the current AUM that we were mentioning. What are the returns, and since when the scheme is in operation. Since 2007 the scheme is in running, which is really great. Mr. Rohit Singhania, who is the fund manager, and other details of the scheme you can see, followed by the calculator. And in order to invest, either you can click buy from here, sell from here, or you can put up an SIP. However, it is always advisable to check out in the login section. So once you go to login section, you simply have to enter your login credentials. Just log in and show how to place the order. And also, as we have our research team who provide the research reckoner, that also I will show it to you where you will find that. You can click on mutual funds, click on one-time investment, and right here you can see this download report. Once you click on it, this is how the PDF would be downloaded. You can scroll it down, and here you can see all the schemes that are there and the different categories what we have as per our research team. And under the ELSS category, you will see here DSP Tax Saver Fund. It is a part of our research record, and 4-star rated as well. So you can check the details in the regular. However, in order to place the order, simply you need to type out here DSP Tax Saver. The moment you click on it, instant window will open. You can enter the amount that you wish to. It is not only recommended that whatever is the remaining balance in ATC you should put. If you are focusing towards wealth creation, as ma'am rightly mentioned, that it have a lock-in of 3 years, which is actually a blessing in disguise, because with that note you actually do not withdraw your funds for next 3 years, which eventually help you to create your wealth, right? So because equities are always great in long term, what we have seen, the last CAGR since inception, if we see of Nifty, is about 15%, which clearly indicates, despite being the volatility and being volatile, I'm sure it's a characteristic of market. If we are focusing long term wealth creation, then we should definitely go ahead and put in the amount. And as ma'am rightly mentioned, this is the time because the markets are on the downfall. This is, you can say, it's a sale time wherein you can buy units at a much discounted price, and when they will come back to their normal level, that's a sheer bonus for you. And from there, it will keep on increasing as well. Right. So right here, you can enter the amount and you can click on place order and confirm your order will be successfully placed. Similar thing can be happen from mobile application also. If you have HDFC Securities account, download the mobile application. Already more than 1 million subscribers have downloaded and they are getting benefited on the go. And you can also download it just within 2 to 3 clicks from our mobile app. You can place the orders and you can check your portfolio on the go, right? And the investors who are watching us right now who have not yet opened HDFC Securities account, so I have again two options for you. If you have HDFC bank account, you can simply go to, if you haven't opened 3-in-1 account and if you wish to do only mutual fund, because the time is limited up till 31st March, you have time to get the tax exemption, tax benefit. So if you have available space, you can log into your net banking, click on mutual funds tab, just scroll down at the bottom of the page. There you will find invest now option. Invest now is an exclusive platform that we have launched only for mutual fund customers, which comes to you absolutely free of cost, with no account opening charges, no transaction charges, and no annual or quarterly maintenance charges. It's an absolutely free mutual fund platform. So for HDFC bank customers, they can do that. And the investors who are watching us right now who do not even have HDFC bank account and do not have HDFC securities account also, not to worry. For them, we have launched Digify. Digify, right here you can see on our website, that's hdfcsec.com. On our website you will see the icon out here. I'm just moving my cursor here, the second last option, Digify, which is wherein you can open this platform, mutual fund platform, and link your existing bank account and start your investment journey instantly, right? Because you still have time. This just takes about 10 to 15 minutes of time if you are a non-HDFC bank customer to open Digify by entering your PAN card details. Just ensure you are mutual fund KYC compliant and you are a single account holder with your existing bank. So that's all. Now we are open for Q&A. Let's see what questions we are getting from our investors. So the first question we are getting, ma'am, it is about shall we do a SIP at this point of time or lump sum would be better?
Given Ashish, given that the markets have corrected from the highs that we have seen, and it's also beneficial for investors who are going to put money for the next 3 years. Any investment into the tax plan will have a lock-in, as we discussed in detail. I would recommend that the investor could do a lump sum investment as well.
Right. So yes, SIPs are always better, but this is a time where you can do lump sum investment and you can get your tax exemption. Because even if you have not submitted at the time of income tax return file, definitely it would be considered. All the investments done up before 31st of March will be considered. Let's see the next question. Viewers, you have a question mark icon on your screen. When you click on it, a window will open wherein you can type your questions. Next question we are getting, is there any further downfall expected, or we can start or there is correction expected?
Yeah, so this is one of those, what has led to the current market correction is largely due to the coronavirus scare. And I mentioned in the opening remarks that, China is the manufacturing hub of the world, and any impact on Chinese economy will have a bearing on the rest of the economy as well. And, the supply chain gets disrupted for the world in various other things. To some extent, there is a belief that largely in the Chinese economy, the problems have slowly started getting addressed. Many of them have started coming back to work. Their facilities are slowly opening, etc. But the rest of the world, the amount of impact that this can create is not fully assessed. And there are subsequently various theories that go around about the containing of the virus and when the weather conditions change, it could be better, etc. Now, these are all theories and comments by various experts. So we do not know whether this is actually the truth or otherwise. However, from an investor's perspective, any opportunity like this, which is a 5% correction, 10% correction, is always a good time to add on to your existing investment. So I would say that markets have corrected, which is a good value available for an investor. And if there is any further correction, it is additional opportunity to top up your investment. Over a 3 to 5 year period or a 10-15 year period, we have seen in the markets that all such events, be it scare on medical calamities like SARS, Ebola virus, or a geopolitical risk, or a global financial crisis, markets are full of them. Political crisis, various things happen, and for each of these events, markets will react. But subsequent to that effect or that impact or that news value diminishing, the economy, companies, the world comes out of it, and then the growth comes back into the portfolios. So to that extent, every opportunity to top up. Can there be more, market correction, and can there be some more bad news? Quite possible. Each of that should be looked upon as an opportunity to build portfolios.
Absolutely. Let's move to the next question. Few questions we are getting from Mr. Rajiv Kurana, followed by Mr. Ajay Satwadkar. They are asking what would be the tax implication after 3 years?
Yeah, so after 3 years, you would have to pay the long-term capital gains tax because this investment in ELSS schemes allows you tax exemption when you invest. But it is an equity scheme, and when the fund matures and the year that it comes into your account, on that year, it will be treated as a long-term capital gains. And at the current taxation that is prevailing, it is a 10% long-term capital gains tax on equity investments that we will have to pay.
Right, and that too, if it is more than 1 lakh. If it is less than 1 lakh, then absolutely there is no tax. So
yes.
It is completely tax-free, which again, I think it makes this product quite lucrative compared to other 5 years bank FD or any other product, because there even you have to pay tax on
I'll just thanks Ashish for bringing that nuance to the portfolio, the tax treatment. What Ashish meant was that if the capital gains is less than 1 lakh, I do not have to pay the 10% tax as well. So if I'm investing a lakh of rupees, my maturity value has to be more than 2 lakhs for me to have generated a 1 lakh capital gains. Just as an example, I'm quoting. So the current taxation law says that if your capital gains in a year is 1 lakh or less, then that income is completely tax exempt. But if, or you don't pay any long-term capital gains on that. But if my capital gains that I have made on my investment is more than 1 lakh, then on that amount, you will be paying a 10% capital gains tax.
Right. Moving to the next question. The next question coming from Mr. Nitin Pawar, he's saying, is there any provision who do not have account in HDFC can buy mutual funds from HDFC Securities? Absolutely, sir. You can do that. That is where we expertise in providing you the seamless platform where it's sitting at home just in few clicks. 24/7 the platform is available. I have just mentioned earlier. I will recap that again. You just have to log on to hdfcsec.com. Right here you can see this Digify option. And many questions I'm getting on the same. So let me just inform to all our viewers that we have our YouTube channel as well. If you have not subscribed to our YouTube channel, I would request you to go to YouTube, type HDFC Securities. You will get our channel out there. There you can go to a playlist. There are multiple playlists would be visible. Under the playlist, there is a playlist called webinars. So if you click on it, just scroll down about 100 videos down. I have done an exclusive webinar on Digify your family's mutual fund. So that is the exclusive webinar which takes you to the complete account opening journey of Digify, which is seamless. Only you need to be mutual fund KYC compliant, and you should have a valid bank account with an active net banking with the list of 20-25 odd banks. If you have account within that, you can open this Digify account by entering your PAN details and your date of birth. Within few clicks, you can open it, link your existing bank account, not mandatory to have HDFC bank account, and you can seamlessly do investments in mutual funds. Let's move to the next question. Considering the time constraint, and we are getting many questions out here, but again, considering the time constraint, we'll be able to take one or two more. So let's see the next question. Interesting question coming from Mr. Reddy. He's asking, amongst the multiple schemes that we have, there is a dividend option also, and there is a growth plan option also. Again, in dividend also, there are two schemes: dividend reinvestment and dividend payout. So, what do you suggest? How we should take it this?
Yeah. The dividend taxation changed in the recent budget that was announced on 1st of February 2020, which will be effective from 1st of April 2020 onwards. The mutual fund dividends were tax-free in the hands of the investor, or rather, it will be tax-free in the hands of the investor till March 31st, 2020. However, prior to paying the dividend, mutual funds were deducting dividend distribution tax at 10%. So whether you chose a growth option or a dividend option till March 31st, 2020, you were largely having no differential in the tax treatment. In one case, I would pay tax before the dividend comes to my hand. In the other case, you will pay the dividend in the growth of, you will pay the tax after the capital gains is generated by the investor and the investor was paying it. In the case of DDT or dividend distribution tax, mutual funds were giving and the dividends were tax-free in the hands of the investor. However, with the new tax regime from 1st of April 2020, any dividend that is received by an investor is added to the income of the investor and tax has to be paid on the rate of tax that the investor has, that is his marginal rate of tax. That is the new rule on dividends, the dividend taxation rule, which is effective from 1st of April. And therefore, it is prudent to consider that growth option would be better for a large majority of investors. However, let me caution you that it also depends on the marginal rate of tax that an investor is paying. So if there are investors who do not have any tax implication or their rate of tax is less than 10% due to some other benefits that they are getting, then a dividend option could be better. So the best way to do that is to check with your tax consultant or use any of the tax calculators that are available. By inputting your income, you would be able to take a decision. It is difficult to say that for everyone, one option is the final answer. It depends on the income level of each investor, and basis that you should be taking a decision whether to go for a growth option or a dividend option.
Right. So, a few questions we are getting. Can we invest? I have missed out. Can I watch the session again? So definitely, this, if you have joined in late, not a problem. This recording of the same webinar would be available on the same registration link after an hour's time. So by 5:30, you can click on this. You can go to our website hdfcsec.com. As you can see, the second banner is of this webinar. You click on it, and after an hour's time, you can watch the recording from the beginning. Also, it will be uploaded on our YouTube channel within in couple of days of time. So from there also you can access it, right? But just keep one thing in mind: if you're watching this webinar recording by clicking on this link, if you're using a laptop or a computer, you can simply good to go. If you are using a mobile application, open it within the mobile browser, not from the app, because app is generally for watching the live webinar so that you can interact with us and you can ask questions. However, to watch the recording, open it in your mobile browser, maybe a Google Chrome or a Safari as per your operating system that you have. Now we'll be taking the last question for the day. Let's see what questions we are getting. Okay, quite interesting coming up from Mr. Meet Shah is asking, is DSP tax saver fund, wherein the current top 10 stock allocation, will it remains the same or there can be any changes in those allocation?
Good question, Ashish. This is all mutual fund schemes do have a large portion of their portfolio invested for the long term. However, that top 10 stocks or top 15 stocks will remain the same forever is not possible in a mutual fund scheme, because the duty of a portfolio manager is to identify good opportunities in the market, find out the themes or sectors that are likely to deliver returns for the next couple of years. So they identify trends, they identify management changes in businesses, they identify a valuation of companies which are attractive. So there are various metrics or parameters that a portfolio manager uses to construct a portfolio. And as part of the framework and the construction of the portfolio that they do, some of the stocks do change in the portfolio over a period of time. So it is in the interest of the investor and in the interest of the scheme that a portfolio manager keeps his watch in terms of identifying new dimensions of business, new opportunities, and creates a portfolio. At the same time, a good portfolio manager will also have a long-term bias where he does not say that a business is good today and in 2 months he changes his opinion. He does his research well enough to identify companies and own them in the portfolio. There would be a smaller percentage of the portfolio that undergoes a change over a period of time.
Okay. So that's all for now, viewers. Thank you so much for joining in. I'm sure that this was a helpful session for you. So still you have time. If you haven't yet, check your ATC bracket. What is your available limit? Invest in ELSS. GSP Taxaway is one of the best scheme that you can go with. Check our research right, do your due diligence, and stay invested. Thank you so much, ma'am, for coming and giving such an insightful knowledge to our viewers.
Thank you very much. Thank you for logging in, and it was a pleasure being with you.